we will be talking about the outlook for pensions, a very institutional-focused discussion with 4 gentlemen joining us from New York, London, and Amsterdam. And it's my pleasure to introduce you to Sander van der End, Head of EMEA Institutional, Anil Shenoy, Head of UK Institutional, Aaron Kilberg, who is Head of North America Institutional Sales. And this session is hosted by Nick Adams, who is our Global Head of Institutional. Nick, I'm handing over to you.
Great, thank you, Sarah. Hello, everyone. As you just heard from the introductions, we have representation from different parts of the world today to talk about the outlook for pensions. So hopefully this discussion will give you both a sense of the common features of pension plans, different parts of the world, but importantly also those regional variations. And to that latter point, I think we should kick off by looking at regulation and how that's driving the behavior and activity of pension clients. Maybe, Anil, if I can come to you first, how's regulation influencing your clients in the UK?
Thank you, Nick. Good afternoon, everybody. So I'd say from last year, regulation has started to influence, certainly for both DB and DC, portfolio construction and reporting. And as a result, I think we're having more and more conversations around those 2 particular realms. Probably 3 examples I can give. Firstly, on defined benefit, a lot of pension schemes are getting their portfolios ready for the end game in advance of the new DB funding code, which has been delayed, but nevertheless, if your scheme is deemed mature, there's a certain way you need to invest, and schemes are preparing for that. For TCFD reporting, that continues to be on the agenda for both DB and DC. One of the things that is interesting there is the data to calculate the TCFD reports in the various scenarios is still incomplete as an industry issue. So one of the things there we're working with clients on is to try and estimate where the data is scanty. So for example, our secured credit team have done some great work estimating scope 1, scope 2, scope 3 for securitized assets, which are particularly have, relatively speaking, relative to other markets, less ESG or climate-related data. The other thing that we've observed is certainly clients and their advisors are certainly share or spend a lot of work thinking about their areas for engagement and what matters to them. And have been reaching out to us to say, these are the areas that concern us. How can you help us? So I think those 3 areas, but certainly in summary, I'd say that relative to last year, regulation is having more of an impact on how we construct portfolios and how we report to clients.
Great, thanks, Al. Yes, certainly sounds like plenty of regulation influencing clients in the UK. Sander, if we come to you and look at the rest of the EMEA region, how's regulation shaping the activity of pension schemes there?
Thank you, Nick, and good afternoon all. It's a bit similar as to what Anil mentioned across the other side of the ocean, but regulation is certainly shaping the behavior of pension scheme clients. And I think we have to make a separation on both local and EU regulation, because there's a difference there, but our clients are coping with both. And I think on an EU example, I think the biggest impact is still the Sustainable Finance Disclosure Regulation and the complete rollout of that, because that is impact reporting requirements for both asset owners and asset managers like Janus Henderson. And I will also give you a little bit of a flavor of a local example, given the fact that I'm based in Netherlands. The Dutch market is the 2nd largest institutional market after the UK within Europe. And actually, we are in the middle of a pension reform. And that is very significant because, in essence, we are transitioning from a defined benefit to a defined contribution system. And this is impacting 1,500 billion euro of pension fund assets. So you can imagine that the implications for our clients are significant. And this impacts their administration, it impacts their investments, because the new system is linked to the risk appetite of all those individual members instead of having a collective approach. In essence, this is impacting their allocation decision as well for investments going forward, which is relevant for an asset manager like us. So how much do they still need to hedge from interest rate hedging for their liability portfolio, which will disappear, but now you have age cohorts. And also, how do you cope with specific return generating investments? So clearly a lot is happening over here.
Thanks, Sander. Finally, then, Aaron, how is regulation influencing the clients that you talk to in the US?
Thanks, Nick. Good afternoon, everyone. Happy to talk about what we're seeing in the pension market in the US. There are a few items that are top of mind in the US. To start with, the SEC just came out with a marketing rule recently that asked all registered investment advisors to show returns net of fees. This also included attribution performance. Attribution performance is typically used as a supplement to reports to show how managers have either added or detracted from performance. This mostly impacted hedge funds, multi-strat managers, especially those that have sector investments. As you can imagine, this was timely, trying to go back to determine whether these plans had that information net of fee by sectors. Most recently, the SEC has reviewed this rule with asset managers, and it's our anticipation that they will revoke the marketing rule. Also, in light of the recent Silicon Valley and First Republic Bank failures that we've seen in the US, the Federal Reserve is looking to make changes to expand the asset client base of regional banks. We're not sure if there is a potential looming another regional bank failure, and this is a way of trying to head this off in the US. Lastly, we are seeing mixed legislation and regulation on the integration of ESG into state pension plans. In the US, this is a heated conversation as some plans believe it either detracts or adds value to the portfolio. Some states like Texas and Florida have legislated bans to eliminate ESG in their pension plans and have actually terminated managers that have violated this rule. So again, a mixed bag on the ESG front. I know we'll be talking more about that later this afternoon.
Great, thank you. So plenty of regulatory drivers in summary, but playing out quite differently in regions, as we might expect. Why don't we move to investments now, affecting pension schemes? And Sandra, if I come to you first on the EMEA region. Last year saw a number of factors influencing investments. We had the start of the conflict in Ukraine, the rise of inflation and interest rates, also a big focus on liquidity from a number of our clients towards the back end of the year in reaction to market environment. Do those factors still play this year as you look at your clients?
Yes, they definitely do, Nick. Although things changed, it's good to step back a little bit and look at 2022 first. Because in essence, what we notice is that because of the turbulence on the financial markets, assets dropped across the board. But the interesting thing is that the way our pension fund clients are measuring their liabilities versus their assets, the interesting thing is that actually the funding ratio improved for defined benefit pension funds. And if I put some numbers to it, for example, for Dutch pension funds, actually the funding ratio improved, actually the average funding ratio improved from 110% to roughly 120%, while the overall assets dropped with almost 400 billion in value. So that's an interesting contradiction in that sense. And also we did notice differences per region. So if we look at our sovereign clients in the Middle East, for example, they actually profited from higher commodity prices and a stronger dollar and generated more revenue there. You mentioned liquidity. We certainly experienced some liquidity constraints, particularly related to margin calls related to interest rate swaps. And what we noticed is that particularly those derivatives, they generated roughly 165 billion euros of losses. But the interesting thing is that there was enough liquidity from the collateral from our clients, which were mainly government bonds and some IG bonds there. So we actually did not really experience any forced selling, although we did notice a little bit in the UK to some extent to that, but not really, for example, in the Netherlands. And if you look back on today, and you make a jump for where we are now, it's completely different. We changed from a negative to a positive interest rates environment. We are slowly getting to the end of the rate hike cycle, and clients are preparing for that and adjusting their portfolios slightly where needed. And we will touch upon that later on as well.
Thank you. Anil, coming to you, Sandra talking there about liquidity. Fixed income is often seen as a natural asset class for pension schemes, particularly maturing defined benefit plans. following the gilt crisis we had in the UK last October, what trends are you seeing with your clients with relation to fixed income?
Thanks, Nick. Yeah, it was pretty exciting in October, but thankfully the dust has settled somewhat since then. And pension schemes in the UK, certainly, we've started to see evidence that they're revisiting their investment asset allocations. Now, there are a number of reasons for this. If I can just pick three out. For some schemes, I wouldn't say all, but some schemes, as Sander mentioned, the funding position of the scheme has improved. And so the assets and liabilities are they're in more of a surplus, thus reducing time horizons. The second point I'd say is some schemes are now overweight in illiquid assets, having sold down their liquid assets to make collateral calls. And then thirdly, going back to regulation again, the collateral buffers required for LDI portfolios are now pretty stringent following what happened in October. And these three things has meant that pension schemes are looking at their asset allocation and saying, right, what's going to take us to our end game? What is a portfolio that is most efficient to be able to do that? And for some of those schemes, that is a cash flow match portfolio using a selection of government bonds, corporate bonds, securitized, even high yield, and taking advantage of some of the opportunities that Karina had mentioned in her session just a few minutes ago. And so constructing those portfolios is what we've been doing for some of our clients who are at that stage. And those portfolios are fulfilling a number of different dimensions, matching interest rate inflation exposure, generating cash flow, and get them onto the road to maybe an insurance buyout, particularly because the insurance buyout market is going to see a flurry of activity, but whether they have capacity to absorb all this in the short term is under question. So getting ready for that takes some time. So lots of things going on there, Nick.
Good stuff. Thanks for the fixed income view. But Aaron, coming to you in the US, clients there we're seeing adding to their equity allocation. Do you want to talk to us a bit about the drivers behind that?
Sure. There are several drivers. First, as we are seeing that public funds are increasing their equity exposure as they are considerably underfunded and not meeting their target returns at this point. In fact, according to the National Conference of Public Employees Retirement Systems, the average funding ratio for public plans in the U.S. at the end of 2022 was 78%. So they are continuing to look to add to their growth buckets, and this is primarily at private equity as well as public equity investments. Second, we have seen a recent run-up in private equity in our portfolios here in the U.S. due to the underperformance of public equities. So plans are using this as an advantage to rebalance the portfolios and to add more liquidity by investing in more concentrated long-only equity strategies. And lastly, over the last few years, U.S. equities have outperformed non-U.S. equities. So we're seeing this as an opportunity for plans to invest in non-U.S. equities to increase their asset allocation mix in this particular area, mostly in international, global, and emerging market equity portfolios. So those are the primary drivers that we're seeing right now in the U.S. and the equity markets.
Interesting to hear the difference in funding ratios there and the direct impact that has on asset allocation and how people are managing their portfolios. Let's turn to ESG. Sandra, if I can come to you first, European investors are sometimes seen as leaders in this area. What sort of trends are you seeing now from pension scheme clients across Europe?
Yeah, you're absolutely right that ESG remains key for our clients, in particular in markets like the Nordics and in the Benelux. This is critical for them. And some of the themes are out there for some time. So, for example, climate transition is not a new theme. It's not a new trend. But it's there, it becomes more intense, there's more data involved with that, and I already touched upon that before. And this is clearly something which rolls through the portfolios of our clients, not only in equity classes. It's interesting to also notice that it's moving beyond equity classes to fixed income and for example, to investment grade and high yield portfolios. Another trend, what we are seeing to pick up much more, particularly this year, and it already started last year, that is biodiversity. that is also getting much more attention from our clients. So I think these two themes are critical for them. And there's something else to mention, that we do help our clients going forward with customization for example, transitioning with climate and reducing the carbon footprint, but it also adds much more complexity because there's no standard in the market. So I would raise that as well. And then the final thing I would like to add, and that is also connected to what Anil said in the beginning, data is crucial and it remains challenging for our clients and for asset managers. And we see an increased effort to improve the accessibility, to improve the quality of data. So in the end, we can make better informed decisions and measure the impact of ESG. And I do believe that active managers like Janus Henderson can help clients with that journey.
Aaron, you mentioned ESG earlier. Do you want to expand on what you're seeing across the US in this area?
Sure. Unlike Europe, the U.S. is behind in incorporating ESG into their pension plans. It's currently in an educational phase in the U.S., and we're trying to explain what the shortcomings and potential disadvantages of not having ESG in your portfolio would be. In some cases, we are seeing firms that have European counterparts as compared to U.S. companies having an advantage as they're able to provide partnership, bespoke solutions, having more, being more regulated, being more focused on this particular market. And most important to our clients is knowledge transfer, being able to explain this to the pension plans. Now, in the U.S., ESG is a mixed bag. Endowments and foundations have typically been the leaders in this space, most recently through the divestment of fossil fuels. Canadian plans are early adopters, and we are seeing some states and corporate plans adopting ESG integration, but typically it is based on state location, what state they're located, their plans are located in. In general, most clients seem to be fine with ESG integration if we can demonstrate how it can be a mitigating risk opportunity for them. It could avoid any material financial risk in the portfolio. And I think, as Sander has mentioned, can demonstrate the effectiveness and value add of being able to show you how your engagement practices have added to the portfolio, either through reporting or rating systems.
And some of that playing back directly to what was being talked about on the previous panel from Michelle and the others. Anil, coming to you then finally in the UK, ESG, how's that playing out now with pension schemes in your region?
As I mentioned, Nick, at the start, a lot of pension schemes, a lot of trustees and their advisors done a lot of work thinking about ESG and what it means for them and what it means for the trustees, directing us in areas of engagement and so on. But our role here is, and it's just echoing what Michelle said in the panel, is really to help them understand what is possible, given data requirements, risk return objectives, and so on. So these are the conversations we're having. So an example of this is very recently, one of our clients, a UK pension fund which invests in equities, Rarity, wanted to change their benchmark to meet their low carbon requirements. And so we spent some time with them to understand their requirements and look at the benchmark and ascertain what we thought right now was the best way to achieve those goals and how we do that by developing a segregated portfolio. So having those conversations and dialogue has been a focus for this year. The other thing I'll mention is I'll shamelessly plug the Mount Street survey that we sponsored earlier on this year. The Mount Street survey is available, so Janus Henderson sponsored it, and it shines a light on various different areas, including ESG. And one of the things in there, it showed, and we're seeing this, a difference between ESG with defined benefit and defined contribution. Where defined contribution trustees are looking at ESG as a means of engagement with their members, the members being a little bit younger, shall we say, because their schemes are still open. Again, an interesting dynamic there. But lots going on, Nick, in ESG.
And some interesting findings across that survey. So yeah, thank you for flagging that. I'm just conscious of time. I was going to ask one sort of wrap-up question to each of you. This is called about the panel's called the Outlook for Pensions. So thinking ahead, what are the main areas of focus and priorities for pension schemes or pension plans in your region? And maybe Aaron, if I can come to you first with North America.
Yes. So looking forward, thanks, Nick. Looking forward, corporate defined benefit plans are either frozen or closed in the U.S. They are nearly or close to 99% funded and are seeking the end game solution of how to transfer these assets off the books. They're de-risking the portfolios. They're investing in LDI. They're looking for fixed income diversifying strategies. Some still have a growth bucket, but this is shrinking as they reach that funding status. They're also looking to add and replace managers in their DC plan and also target date funds. But typically, we're seeing this in the staple equity and fixed income strategies. On the public fund side, that's a little bit different. As I mentioned earlier, these plans are still trying to improve their funding status. So they're looking to add exposure to both diversifying fixed income assets like structured securities, securitized capabilities. They're also looking at growth buckets like private credit, private equity, and public equities. Some are thinking about LDI as they get closer to that target funding status, although with some plans having COLA mandatory adjustments, that's going to be a little difficult for them to meet their liabilities. And lastly, I would say that public plans are beginning to embrace the defined contribution market, but early stages here for that in the U.S. It's typically as a supplement to their DB plan.
Very good. Plenty coming in North America. Sander, to you in Europe, the outlook there for pension clients.
Yeah, I will mention a couple of points given the time, Nick. Outcome-based ESG is a key thing. Defined benefit pension funds, which have a strong funding ratio, might lock that in by increasing their interest rate hedges. So that's clearly on top of the agenda. The analysis of potential impact of inflation if it would stay at more elevated levels, and linked to that, the need and search for more diversification continues. And finally, it was already mentioned by Aaron, for the shorter term, I do believe that certain private assets might see less commitments due to more attractive opportunities elsewhere as a result of those higher spreads and interest rates.
Anil, to finish us up, the outlook for pensions in the UK?
Kind of echoing what Sandra and Aaron have said in their regions, for defined benefit pension schemes preparing for the end game, looking at portfolios for cash, generating cash flow, taking advantage of what's going on in the liquid fixed income markets. Fund liquidity is obviously important as well. And for both DB and DC, it is ESG. It's looking at working with clients, helping them understand how to meet their objectives in terms of ESG and what's possible given data constraints and risk and return objectives.
Okay, so we finished there with some common future steps for pension schemes in different parts of the world, but throughout this session, hopefully we've also highlighted some of the regional variations across the different topics. Hopefully we've answered the questions that you had. If we haven't, please do submit them to your usual contact and we'll make sure we do follow up. But that just leaves me to thank my panel, Sander, Aaron and Anil.